Exercise 10.6 gives us an opportunity to explore a couple of different types of stock. This company has two types of stock authorized. Their common stock is dollar par, and then they tell us that their preferred stock is $100 par, 8%. And you know that that means that every time there's a preferred dividend, the preferred shareholders get 8% of $100. They get an $8 bill, and everything else goes to the common shareholders. Well, they tell us that on day 2 of the year, January 2nd of their first year in business, they issued 100,000 shares of stock, and they issued them for $35 a share. This is exercise 10.6 on page 491. So 100,000 shares at $35 per share, they got a total of $3,500,000 in cash. They also got $100,000 in additional paid-in capital, common stock, because we listed at par. So there's $100,000 paid-in capital at par, because we always do this at par. And the difference, the $3,400,000, is additional paid-in capital. Used to be called capital paid in excess of par. However you want to remember it, it's fine. That's the way it goes. Now, they tell us on February 6th, we issued 3,000 shares of our preferred stock at $11 per share. So let's see. So 3,000 shares of preferred stock at $11 per share, that's $33,000. That's how much they got. The preferred stock at par is $30,000. 10 times 3,000, 30,000. And the additional paid-in capital is the 3,000 shares at $1 a share. That's $3,000. And as I'm looking at this, I realize that their preferred stock is not $100 par, it's $10 par, which means each time the shareholders get a dividend, they get 80 cents, not $8. You have to read these things carefully. It's easy to confuse them, as I just proved. And I didn't do that on purpose, although I would like to tell you that way you think I'm smart. I'm not. Okay. Now, on September 10th, we're going to buy back some of our shares of stock. We're going to buy back 11,000 shares of our stock at $40 a share. So we're going to buy them back, 11,000 times 40. That's what, 440,000? Right? 440,000. So that's a debit to treasury stock and a credit to cash for 440,000. Keep in mind that treasury stock makes the value of the company go down. It reduces the value. It makes it less. They're giving out assets, so the assets are going down. The size of the company is going down. It's getting smaller. Now, on December 15th, we sold 5,500 of those shares at $5 per. Once a share becomes treasury stock, you ignore the original par and just focus on what you paid for it when you bought it to put it in treasury. So we do this calculator dance of 5,500 times $45 per share, and that comes to 247,500. The treasury stock at what we paid for it. That acts like the new par. It's not called par, and it isn't par, but you act as if it is. So we have 5,500 shares at $40 a share. That's $220,000. Now remember, that reduces the treasury stock because it's a credit. Treasury stock carries a debit. So this reduces the amount of treasury stock, and the difference between the 247,500 and the 220,000, the 27,500 is additional paid in capital. Usually you would mark that treasury stock, but not always.